Satya Skills. In this video, let us learn something about cash credit. What is this cash credit and all? Let us try to understand. Banks offer loans and advances to customers in various forms. Broadly, they can be classified into two classes: secured advances and unsecured advances or loans, whatever it may be. Usually, bank advances or bank loans are secured loans. Secured loans are sanctioned in different forms. Terms and conditions, nature of distribution of loan to the borrower and privileges to borrower differs in each case. The following are some of the important modes of providing loan facility to bank customers. Of this, cash credit is very popular one. In this video, let us learn about cash credit. Cash credit is popular method of granting advances to borrowers in India. Cash credit is a type of loan under which bank sanctions loan with a fixed limit called cash credit limit, and up to that limit customer can withdraw money from his loan account. Cash credit can be defined as an arrangement by which a bank allows its customers to borrow money against some tangible security or a bond with the banker, but usually it is a tangible security. Tangibles means like a fixed assets, gold, or whatever it may be. Under the method of cash credit, borrower applies for a loan specifying the amount that he requires. That means, first thing is that he need to apply for the loan. Usually traders, industries, business people apply for cash credit for working capital needs. Depending on the nature of need of customer or their already sanctioned limits or the repaying capacity of the customer, bank sanctions the limit called cash credit limit. After the release of sanction order, the amount is transferred to the account and the customer is allowed to withdraw money from the cash credit account according to his requirements. Cash credit account can be operated as a current account and the customer can deposit their surplus funds to the account. Then what is the security? Banks sanction cash credit facility against a tangible asset as security. It may differ from customer to customer depending on the nature of his business. Usually they can give any like commodities if they are the business people, or any tangible one they can give. Then interest is charged on the actual amount utilized by the borrower. This is important point you need to remember. So when he draws money, whatever amount of money he draws from his account and uses, interest will be charged only on that particular amount withdrawn by the borrower. Coming to the other part, so remaining part what will be there? That is, they collect commitment charge. Banks usually collect 1% commitment charges on unutilized credit limits. The RBI circulates directives in this regard to all the commercial banks. RBI instructs banks to collect these charges because to make the borrowers to use finance in an effective way. There is one reason to improve better fund management skills of the banks. It's all are okay, they say like that, but basically it is for fund management. So commitment charges are exempted to the SIC units, export finance, and they give certain loans to other banks. For them, these commitment charges are exempted. Then what are the advantages of cash credit? Borrower need not utilize total loan sanction at once, and whenever he requires, he can draw amount. That's the biggest advantage. If he has surplus, he can put back amount in the account. Customer has to pay interest only on the amount he has withdrawn from the account, but not on the total amount. This is the greatest advantage. It is enough to maintain one account for all transactions. And with regarding some limitations, under this system, credit limits are fixed within which customer can utilize funds. Thus, even if he does not require funds, he gets the loan, and additional funds may be diverted towards non-productive uses. That is, we all know that. Under this system, banker has no control over the end use of the funds, and it leads to inefficient management of funds if not properly maintained both by the customer, sometimes maybe the banker also. That's all in this.